Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets of the corporate world. And today we're diving into NRX Pharmaceuticals with a look at their latest -3 filing. If you are interested in how companies raise money and what that means for their future, you are in the right place. And hey, if you like getting these insights straight from the source, make sure you are subscribed and join our Discord community linked in the description below for even more discussions. This filing is all about NRX Pharmaceuticals wanting to offer a whole lot of different types of securities, up to $150 million worth. Think of it as a big toolkit for them to bring in cash from investors. They can issue common stock, preferred stock, debt, warrants, and more. It is basically them saying, we might need money for our operations and growth, and here are all the ways we can get it. Now, this document is a registration statement, which is a big filing with the SEC. It tells investors what the company plans to do with any money it raises. They've checked a box here that says they plan to offer securities on a delayed or continuous basis. This means they are using something called shelf registration. It is like having a shelf stocked with securities they can pull down and sell whenever the time is right, or when they need the cash, rather than doing one big offering all at once. This gives them flexibility. The company is amending its registration statement, which is a common practice. It is like updating a plan. They are noting that this registration statement will become effective at a date determined by the SEC or when they file a further amendment. One of the interesting parts here is that they are re-registering unsold securities from a previous filing. This means they had registered a certain amount of stock before, and they still have some of that left. They're carrying over the registration for those unsold securities, which is a smart move to avoid paying new fees for the same thing. This relates to their previous registration statement filed back in 2022. It shows they are managing their existing registrations efficiently. This box being checked confirms that they intend to sell these securities over time, not just in one go. This is a key indicator of their ongoing need for capital or their strategy to gradually access the markets. Here is something important for investors to note. NRX Pharmaceuticals is identifying itself as a non-accelerated filer and a smaller reporting company. This means they have less than $75 million in public float. For investors, this usually translates to less detailed financial disclosures and fewer reporting requirements compared to larger companies. They get to present only 2 years of audited financial statements, which simplifies things for them, but means you might not get as much historical financial data. This statement essentially means they are keeping their options open regarding when exactly this registration statement goes live. It is a standard legal clause to maintain flexibility with the SEC. This clearly indicates that the document you are looking at is a draft and is not yet finalized for public offering. The actual date of effectiveness will be determined later. Now we get to the heart of the offering. This section details exactly what they might offer. This is the maximum amount of money they are looking to raise through all the securities combined. It is a significant sum, suggesting they have substantial plans or needs. They are listing a broad range of securities they might issue. This shows flexibility in how they can access capital. Common stock is straightforward ownership. Preferred stock can have different dividend or voting rights. Debt securities are loans to the company, and warrants give the holder the right to buy stock at a certain price. This comprehensive list means they can tailor their fundraising to market conditions and investor appetite. This is crucial information for potential investors. It tells you that their stock is publicly traded and provides the most recent trading price. A price of $2.2 per S-share on the 11th of December 2025 gives you a tangible reference point for the company's valuation at that time. This explains how they plan to sell these securities. They can work with investment banks, underwriters, brokers, or even sell directly to big investors. The term continuous or delayed basis again points to their shelf registration strategy. This is a standard but vital warning. Every investment carries risk, and companies are required to highlight these. They point you to the risk factors section, which is where the real cautionary tales are. This is a critical disclaimer. It means the SEC has not said these securities are a good investment or that the information provided is flawless. It is the investor's responsibility to do their due diligence. The table of contents is your roadmap to the document. It shows the different sections from the summary and risk factors to descriptions of each type of security they might offer. This section clarifies how to interpret the document. It is important to understand that the prospectus supplement, which will be released for each specific offering, will contain more up-to-date and specific information. If there is a conflict between the main prospectus and the supplement always wins. The summary is designed to give you a quick overview, but it is essential to read the full document. This is helpful for understanding who we refers to. It is not just the parent company, but also its subsidiaries, which is important for understanding the consolidated financial picture. Here is a glimpse into what NRX Pharmaceuticals actually does. They are a clinical stage biopharmaceutical company focused on developing drugs for central nervous system disorders. This includes conditions like suicidal depression, chronic pain, PTSD, and schizophrenia. They also have a stake in a medical services company that offers interventional psychiatry. Their main approach involves drugs that modulate the NMDA receptor, which is a key pathway in the brain for plasticity, or the brain's ability to change and adapt. These are their key products in development. NRX 100 is based on ketamine, a well-known anesthetic that also has antidepressant properties. NRX 101 is a combination drug. Developing new drugs is a long, expensive, and risky process with a high failure rate, so this is a major part of their business strategy and also a significant risk. This is where the company lays out all the potential bad things that could happen. We've already touched on this, but it is worth reiterating that investing in biotech is generally high risk, high reward. Factors like regulatory approvals, clinical trial success, competition, and funding are all critical here. As we noted before, being a smaller reporting company means simpler financial reporting. While this reduces their compliance burden, it also means less transparency for investors. You have to be aware that you might have less detailed information to work with compared to larger companies. This section gives you the company's legal structure and history. They were incorporated in Delaware as Big Rock Partners Acquisition Corp. And later changed their name to NRX Pharmaceuticals, Inc. after a business combination. This is standard corporate background information. This part details the company's stock. They have authorized a huge number of shares of common stock, 500 million, and some preferred stock. As of December 2025, only about 29.6 million shares of common stock were actually outstanding. This means there is a lot of room for them to issue more stock in the future, which can dilute existing shareholders. Holders of common stock get one vote per share and are entitled to any remaining assets if the company liquidates. They have no preemptive rights, meaning they can't automatically buy more stock if the company issues new shares to prevent dilution. This is a common feature in many companies and generally means existing shareholders may not have the ability to maintain their ownership percentage easily if new stock is issued. The board of directors has the power to create and issue preferred stock without shareholder approval. This is a significant point. They can set the terms of preferred stock like dividend rights or voting powers, which could potentially affect common stockholders negatively, perhaps by restricting dividends or diluting voting power. It gives the board a lot of flexibility, but also a lot of power that could be used in ways that aren't ideal for common shareholders. They currently don't expect to pay any cash dividends for the foreseeable future. They plan to reinvest all earnings back into the business to fund growth. This is typical for a company in their stage of development, but it means investors seeking income through dividends will not find it here. These are rules designed to make it harder for someone to take control of the company. Provisions like a classified board of directors and advance notice requirements for shareholder proposals can make it difficult for activist investors or potential acquirers to make rapid changes, while intended to protect the company and its long-term strategy. They can also limit shareholder influence. As mentioned earlier, the large number of authorized but unissued shares can be used for various purposes like acquisitions or employee stock options. It also means the company has the power to issue a lot more stock, which could dilute existing shareholders if not managed carefully. This means the board is divided into 3 classes, with only one class up for election each year. This makes it harder for shareholders to quickly change the board's composition, which can be seen as a way to ensure continuity, but also as a way to resist shareholder pressure for change. The rules here make it difficult for stockholders to take action by written consent. They can only act at officially called meetings. This means you can't just gather enough signatures to pass a resolution without a formal meeting. Also, only certain company officials can call a special meeting, limiting the power of individual shareholders to convene one. This is another requirement that makes it harder to quickly bring new proposals or nominate directors. Shareholders have to give a lot of advance notice and follow specific procedures. This can prevent last-minute surprises, but also makes it more challenging for shareholders to voice their concerns or propose changes effectively and in a timely manner. Changing the company's core rules requires a supermajority of shareholder votes, specifically 66 and 2/3%. This higher threshold makes it more difficult to alter the company's governing documents. The company provides broad indemnification to its directors and officers, meaning it will cover their legal expenses and liabilities in many situations. This is standard practice to attract and retain qualified individuals, but it can also shield them from some personal accountability. This is an interesting legal clause. It states that any lawsuits related to the company's internal affairs must be filed in Delaware courts, and any claims under the Securities Act must be handled in US federal courts. This is designed to keep legal battles in specific jurisdictions and can make it more inconvenient or costly for shareholders to sue the company. This section details the terms if the company decides to issue debt. They can issue an unlimited amount of debt, which is significant. This means that if the company cannot pay back its debts, the lenders have a claim against the company's general assets. This section outlines the terms for potential debt warrants. Warrants give holders the right to buy debt securities. This is less common than stock warrants, but it could be a way for the company to offer sweetened deals related to its debt offerings. This is more typical. These warrants would give holders the right to buy common or preferred stock at a set price. They can be offered with other securities to make them more attractive. The specifics of exercise price, expiration date, and adjustment provisions would be detailed in a prospectus supplement. This describes the possibility of issuing rights which are like short-term options that allow existing shareholders to buy new shares at a discount. This is often done to raise capital while giving current shareholders a chance to maintain their ownership stake. Purchase contracts are agreements where investors commit to buying securities from the company at a future date. This is another tool for raising capital and securing future funding. Units are combinations of different securities bundled together, like a share of stock with a warrant. This can make the offering more appealing to a wider range of investors. This section reiterates some of the anti-takeover measures we discussed earlier, as well as Delaware's business combination law, section 203. This law can prevent an interested stockholder, someone owning 15% or more of the company's stock, from engaging in significant business combinations for 3 years unless certain conditions are met. It is another layer of protection against hostile takeovers. This outlines the various methods they can use to sell these securities, including underwriters, brokers, direct sales, and at-the-market offerings. It is a comprehensive overview of their proposed sales channels. Here, the company identifies its legal counsel, Cozen O'Connor, who will handle certain legal aspects of this offering. This section names the company's independent registered public accounting firm, Salberg & Company, Pennsylvania, their audit opinion, which included a note about the company's ability to continue as a going concern, is incorporated by reference. This going concern note is a significant red flag for investors, suggesting there might be substantial doubt about the company's ability to continue operating for the next year. This tells you where to find more filings and information about the company, including the SEC website. This is a crucial part of any SEC filing. It means that information from other documents they've filed, like their annual reports and quarterly reports, is automatically considered part of this prospectus. This saves them from reprinting everything, but it means you need to look at those other documents to get the full picture. They are incorporating their recent Form 10, K for 2024, and their quarterly reports. This part of the filing contains information not required in the prospectus itself. This table shows the estimated costs associated with this offering. The SEC registration fee is listed at a little over $22,000. Other costs like legal and accounting fees are estimated to be provided later, which is typical for offerings that can span various types of securities. This section elaborates on the indemnification details we saw earlier, citing Delaware General Corporation law. It confirms they will indemnify their directors and officers and also maintain liability insurance for them. This reinforces the idea that they are trying to protect their leadership. This is a list of all the supporting documents filed with the registration statement, like forms of agreements and legal opinions. These are promises the company makes to the SEC, such as agreeing to file post-effective amendments, to update the prospectus, and to remove unsold securities from registration. This is where the company's officers and directors sign off on the registration statement, confirming they believe the information is accurate to the best of their knowledge. Now, let's talk about what this all means for NRX Pharmaceuticals. This S-3 filing shows a company actively planning for its financial future, with a clear intent to raise capital through various means. The broad range of securities they can offer provides them with significant flexibility in navigating different market conditions and investor preferences. However, being a smaller reporting company means less detailed financial disclosure, which can make it harder for investors to get a complete picture of their financial health. The mention of the going concern note in their auditor's report, which is incorporated by reference, is a significant concern. It signals potential doubts about the company's ability to continue operating for at least the next 12 months. This is a serious red flag that investors absolutely need to investigate further by looking at the incorporated financial statements. While they have a clear strategy in their drug development pipeline as outlined in the overview, and they are securing tools to fund it, the underlying financial stability indicated by the going concern note is a substantial risk. The company's structure with numerous Takeover provisions and broad indemnification for officers and directors suggests a focus on stability and protection for its leadership, which is common but can sometimes limit shareholder influence. Overall, NRX Pharmaceuticals appears to be in a growth and fundraising phase, employing sophisticated financial strategies, but investors must be acutely aware of the inherent risks in biotech and the specific financial warnings within this filing. Alright, that is our breakdown of NRX Pharmaceuticals' latest -3 filing. What is your take on their fundraising strategy and the financial red flags we discussed? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and be sure to subscribe for more deep dives into corporate filings. And don't forget to join our Discord community for more discussions and to connect with other like-minded viewers. Thanks for watching, and we'll see you next time on Corporate Decoder.